Quick reality check: Singapore. If you disappeared for a week, would your work calendar even notice? If your answer feels a bit uh-oh, this video is for you. Stay till the end for a simple 7-step Singapore game plan to buy back your time with dividend income. And please tap like right now so more Singaporeans see this and stress less. And if you're new here, hit subscribe to Wealth for You for practical Singapore-focused money tips every week. Feeling constantly on? Same. Tonight, why so many in Singapore feel burnt out and how dividend income investing can help you buy back time, peace, and choices. Let's go. This video is for education and entertainment only, not financial advice. Always do your own research. Investing involves risks, including possible loss of capital. Chapter 1. The Singapore Pressure Check. Picture: a regular weekday in Singapore. You're up before sunrise, skimming emails over Kopi, squeezing onto a packed MRT, and by 9 a.m., the chat pings are already raining. Urgent, quick sync, need by EOD. Lunch is a 10-minute bite at your desk. After work, groceries, homework help, maybe checking in on parents. Along the way, you scroll social media, and boom, someone just bought a bigger place, went on a cooler trip, or hit a new career milestone. Prices keep climbing, expectations keep stacking, and your calendar doesn't leave space to breathe. That's our pressure cooker: long hours, heavy workloads, rising costs, family responsibilities, and constant comparison. And here's the big truth: money without well-being is hollow. What we really want is wealth and a life. A plan that pays the bills and leaves energy for family dinners, slow weekends, and actually sleeping well. That's what this video is about. Building money systems that give you back time, calm, and choice. Chapter 2. Prevent and Recover. Imagine your workday as a house party. Stress doesn't knock, it barges in with friends. The first move is prevention. Put a bouncer at the door. That means not biting off more than you can chew. No more, "Sure, I'll take that extra project," when your plate is spilling. It means saying no cleanly and setting boundaries without a 10-line apology. It means refusing to handcuff yourself to a job you truly dislike forever. Start planning the pivot, even if it's just one small step a month. And it means skipping status spending, the car upgrade, the flashy Reno, the lifestyle creep that locks you into higher bills and higher stress. Less overhead equals fewer 3 a.m. wake-ups. Still, some nights the party gets rowdy. That's where recovery is your first aid kit. Keep it simple. Daily movement. A brisk walk beats ego lifting when your nervous system is fried. A 5-minute journal to empty the mind before bed. Mindfulness moments. 3 slow breaths before meetings. Screens down an hour before sleep. And lean on your inner circle, family and friends who listen, and yes, return the favor. None of this is fancy, but it's how you get your pulse back. Finally, reframe retirement. It isn't a date on your IC, it's freedom of choice. If you're doing work you enjoy, you're already partially retired on the inside. Don't fear a long career, fear doing the wrong thing for a long time. Build a life where your calendar reflects your values, not just your inbox. Chapter 3. Why cash flow calms the mind. Think of your stress like waves at East Coast Park. Some days gentle, some days choppy. Paychecks rise and fall, markets surge and sink. That's swell you can't control. But dividends and interest? Those are the breakwaters. They land in your bank account month after month or quarter after quarter, and your heartbeat follows. Slower, steadier. This isn't about calling tops and bottoms or outsmarting every headline. It's about stacking reliable cash flow from CPF LIFE, T-bills, bonds, REITs, dividend stocks, until your essential bills are covered without asking your boss for permission. Once your basics are paid by passive income, work becomes optional, negotiations get easier, and your calendar starts answering to you, not the other way around. Chapter 4. CPF as your safety net. Before you build anything tall, you pour a strong foundation. In Singapore, that foundation is CPF. Think of it as the concrete slab under your financial house, risk-free, volatility-free, and designed to pay you steady CPF life income when you're older. Here's how you thicken that slab. If it fits your situation, top up your SA or MA, and consider OA to SA transfers when you don't need OA for housing. You're trading short-term flexibility for higher compounding and, in some cases, tax relief. Small moves today that make a big difference to tomorrow's monthly payouts. Once that base is solid, your mind gets quieter. Essentials are covered by a system that doesn't care what the market did this week. That's your floor of peace, and it lets you stack everything else, like T-bills, bonds, REITs, and dividend stocks, on top without losing sleep. Chapter 5. Build many streams. Your foundation is set. Now it's time to turn on the taps. Don't rely on one giant hose. Build many small streams that flow, rain or shine. Start with the predictable tap T-bills, SGS bonds, and fixed deposits. These are your calm waters, lower drama, steady interest. Then add the business tap dividend stocks and REITs. You become a co-owner of real companies and properties that pay you for showing up as a shareholder. If it truly fits your life, consider a property tap. Even renting out a room can be a sensible, low-drama way to boost cash flow. But before you connect any tap, do a quick leak test. Where's the money really coming from? Understand the engine. If the income story sounds magical, it's probably not sustainable. Can it pay? And will it pay? Profits fund payouts, but policy decides if those profits reach you. Look for a clear, consistent distribution history. How much debt? High leverage turns drizzle into flood when times get rough. Prefer strong balance sheets over heroics. Do they treat owners well? A shareholder-friendly track record through good and bumpy years is worth its weight in calm. When each tap passes the test, turn it on, one by one. Soon you'll hear it, drip, drip, drip. A chorus of cash flows filling the bucket. That sound? It's the sound of options. Chapter 6. When to buy, hold, or let go. Markets feel like a pasar malam. Bright lights, loud stalls, FOMO everywhere. That's exactly when you keep your war chest zipped. During euphoric weeks, you stack cash, not positions, so when a real storm hits and good assets get tossed out with the bad, you can walk in calmly and name your price. When prices slide, don't panic swipe. Add to the payers you already understand, the ones with steady profits, sensible debt, and a history of sharing cash with owners. If the business story hasn't changed, falling prices are simply a sale sign. Then do the dull, magical thing. Hold for years. Let dividends drip, reinvest when it makes sense, and watch compounding turn small streams into a steady river. It's not flashy, but neither is your heart rate, and that's the point. And yes, sometimes you let go. If the income case breaks, payouts keep getting cut without a credible plan, debt balloons or the balance sheet looks wobbly, hit sell and redeploy. Other times you simply trim after a big run-up, when a position grows too large, or when the price sprints far ahead of value. No drama, just housekeeping. Buy when the story is strong and the price is kind. Hold while the checks keep coming. Sell or trim when the facts change, or when the portfolio needs rebalancing. That's how you stay in the game long enough to win it. Chapter 7. Start early. Save hard. Stay sane. Picture a tiny durian seed in your palm. It looks like nothing until you give it time. Money works the same way. Even a modest 5% on a small base doesn't look like much this month. But let it roll for years, and you'll wonder when that seed became a tree. So start now. Not when the bonus comes, not when markets feel safer. Set a small auto-invest today, and let compounding do the heavy lifting while you live your life. Next, Make room for investing without making life miserable. Trim wants, not needs. Keep the copy, maybe skip the constant upgrades. Fewer impulse gadgets, fewer prestige ride shares, fewer just because online carts. Every dollar you don't send to status goes to future you. And future you is surprisingly grateful. If you can stomach a sprint, monetize spare time for a season. A short burst, weekend gigs, tutoring, freelance projects, upskilling that bumps your pay can supercharge your capital. Not forever, just long enough to fill the war chest and switch on more income taps. And yes, read the research reports. They're great for facts and context, but they're not your compass. Use them as inputs, then make your own decisions that match your goals, risk tolerance, and sleep-at-night level. The plan isn't to impress anyone. It's to build a calm, boring machine that quietly funds your best life. Chapter 8. Why Comparing Hurts. Two runners set off at sunrise. One takes a flat park loop, the other climbs Mount Faber stairs. Same distance, totally different effort. Portfolios are like that. Your starting capital, timeline, family commitments, and risk tolerance are your terrain. Comparing your returns to someone else's Instagram screenshot is like comparing marathon times on different routes. It only steals focus. Worse, comparison breeds bad behavior. Chasing hot tips, overtrading, or taking on leverage you don't truly understand. Instead, define your number, the monthly passive income that pays essentials and leaves breathing room. Maybe that's $1,200. Maybe it's $3,800. Write it down. Then track your progress savings rate, dividend and coupon growth, payout stability, and, most underrated, the sleep-at-night factor. Celebrate small wins. Auto-invest turned on. Dividends reinvested. A calm annual review where you tweak, not thrash. In money, consistency beats intensity every time. Chapter 9. What a Fed cut means for SG investors. Think of the global economy as weather. When the U.S. Federal Reserve cuts rates, the wind direction shifts. Sometimes it's a warm breeze for yield assets. Borrowing costs can ease, valuations get a gentle tailwind. But umbrellas still matter. Balance sheet strength and sensible payout policies remain non-negotiable. Banks. If the cutting cycle extends, net interest margins can narrow. Dividends may stay healthy, but growth could slow. Watch the pace of cuts, not just the headlines. Bonds, T-bills, fixed deposits. When yields fall, bond prices can rise. But deposit and T-bill rates may drift lower if cuts continue. Decide what to lock in based on your cash flow needs and time horizon. REITs and dividend stocks. Cheaper funding can help, yet only if assets are well tenanted and leverage is controlled. Strong sponsors and prudent managers matter more than ever. Currencies and risk mood. Easier policy can weaken the US dollar and lift risk appetite. Diversify so your plan doesn't depend on one currency, one sector, or one guess about the future. Takeaway. Don't bet the farm on a single macro story. Build an all-weather income plan that works in both slow and fast-cutting cycles. Final thoughts. The 7-step Singapore game plan. Here's your simple, repeatable playbook. Pin it to the fridge. 1. Cut the source of stress. Say no more. Skip status spending. Simplify what you can control. 2. Lock in recovery habits. Walks, journaling, mindfulness, real sleep, and a supportive circle. 3. Pour the foundation. Use CPF as your reliable base. Let CPF LIFE cover a chunk of future bills. 4. Layer the income. Add dividends, bonds, REITs you actually understand. Check balance sheets and payout history. Illustrative examples, not recommendations. Local banks for dividend strength. DBS, OCBC, UOB. Blue chip S REITs for property income. CapitaLand Integrated Commercial Trust, or CICT, Ascendus REIT, bond funds for diversified coupons. PIMCO Income Strategies, understand fees, duration, and distribution policies. REIT ETF for broad exposure. Amova STCA, REIT ETF or CFA. 5. Keep a war chest. Hold cash when markets are euphoric so you can buy quality during big sell-offs. 6. Do an annual audit. If an asset stops paying sensibly, reallocate, no drama, just maintenance. For banks, monitor earnings and capital buffers. For REITs, watch gearing, occupancy, and refinancing. For bond funds/ETFs, review yield sustainability, costs, and interest rate sensitivity. 7. Keep it fun. The goal is options, not obsession. Your calendar should reflect your values, not only your inbox. Fast country, steady plan. Grow your income, reclaim your time, and do work you actually enjoy. Drop a comment below. What's your personal enough number? The monthly passive income that covers your essentials and the one action you'll take this week to move toward it? If this helped, tap like so more Singaporeans stress less, share it with a friend who needs a calmer money plan, and subscribe to Wealth for You for weekly, no-hype, Singapore-focused money playbooks. See you soon. Steady law.